Hi everyone, welcome to another episode. My name is Toby.
My name is Heidi.
And we are going to discuss our Patreon questions. Patreon, what the heck is that? That's where you find our portfolio, our trade alerts, and classes, and you can actually submit your questions. So if you're confused in this space, you don't know what's up, if you want some answer because there's no help desk, well, we are that.
We're trying. We're trying our best. So this is episode 39.
Trying to go through thousands of questions.
We're not a team. I mean, we don't have a team yet. It's just us. So we're humble
us.
Beginnings, but we're doing our best. This is episode 39 of our AMA session. So we've been getting a lot of questions. First one on today's episode. I keep hearing about how large BTC transactions made over the counter, also known as OTC, do not affect the price.
Yeah, you know me.
How does this work? At what point do these big buys affect the price? So first, understanding what over-the-counter means is basically it's a private sale of cryptocurrencies. It's an agreement made between two people. One wants to buy, one wants to sell, and it is not conducted publicly on a centralized exchange. Basically,
the key word there is agreement. So so people are agreeing on it, on a price, and then because I've had several people ask me like, hey, do you know anybody that wants to buy 1,000, 2,000, 10,000 Bitcoin or whatever, and I'm like, no, I don't. But this is exactly what they kind of do. So they ask around, they find out a buyer and a seller, or there can be a broker between the two, and that's kind of how it works. And then that way, you're not like buying on the open market, which will, you're going to move the price if you're buying 10,000 Bitcoin or whatever.
You're going to affect the sentiment of the market a lot more if you're doing it publicly. Even just the act of sending a lot of coins to an exchange is enough to spook people. Not to mention the fact that actually executing this trade on a centralized exchange could easily crash the price on that specific exchange, maybe not generally in the market, unless it's like a sustained thing that they just keep dumping and dumping and dumping. But it can do that because if the volume on that exchange is quite a bit smaller or comparable to the actual amount that one trade is going to be involved in. Like if Binance, I don't know how much they're getting, like how many billions of dollars, but let's say Binance does like $1 billion daily trading volume, and some guy wants to sell $1 billion worth of Bitcoin, they're going to wipe out all of the orders on the order book and crash the price. It's going to be a flash crash. Also asking, like, at what point do these big buys affect the price? Well, they're kind of mimicking the open market value of Bitcoin, right? Because they want to be competitive for these big trades. So if someone buys a huge amount of Bitcoin at, say, $30,000, they're not going to want to sell that unless it's above 30,000, right? They're not going to want to sell at a loss. So if they're smart, so that's going to kind of establish a floor for them. So it's basically, it's the same thing as what happens on the public markets as on the private.
Well, here's what happens. All right, so you have all these huge buyers, and they're going ahead and buying, and usually they're putting it into cold storage or whatever to keep their coin safe because they're not going to sell it. For instance, Michael Saylor is not going to sell his Bitcoin. All these sovereign countries that are buying Bitcoin, they're not going to be selling their Bitcoin. They're getting into it for the long term. So you have this literally the supply disappearing before your eyes. And so if you have less supply and a huge amount of demand with an inelastic supply of Bitcoin, you're going to experience much higher prices, and that's kind of how it happens. But also, you'll have less supply, so that means if somebody wants to coordinate, like a bunch of whales want to coordinate a dump, it's pretty easy. You can spoof markets, which means like putting a bunch of fake orders in and then taking them out really quick and letting the market dump or whatever. There's plenty of ways to kind of like manipulate the price. Yeah. But in the long run, where it's going because all of that supply is being taken off the market. And I think people, the more and more hedge funds, billionaires, family offices that get into this space, the supply is going to dwindle like crazy. So that I remember there's 65 million millionaires in the world, and there's only 16 million Bitcoin that are ever going to be available. So you're going to have a bunch of millionaires fighting over a little supply of Bitcoin.
Yeah.
And that's why I think this Bitcoin is going well over $1 million. But that's on another,
Heard it here
another
first.
subject. Yeah.
Next question. How much do you feel comfortable putting on a ledger, percentage of your portfolio? Divide it up between multiple. In general terms, what do you suggest?
Multiple.
I mean, and just to be clear, if you're ever talking to anyone online or anyone ever about how you store your cryptocurrency, be as non-specific as possible, because that's not something you want anyone to know about, basically. So I think in general, whenever you ask this question, hopefully you're not going to get really specific answers, because who wants to tell you how to get their crypto, basically, right?
Well, let me make a bold statement.
Oh boy.
Having multiple ledgers or multiple hardware wallets or putting in cold storage is the absolute best way
Yeah.
to store your cryptocurrencies, bar none.
Yeah.
As far as like what's on the exchanges, what we do is we have a little bit on just so that we can buy different coins that when they arrive on the
trading
market for
purposes.
trading purposes, but we're not putting anything long term onto the exchanges. So I think that's a really crazy idea. So we try to find coins that we are allowed to stake on a ledger or whatever, and it's just really important.
I think you said it yourself, in general terms is spot on, because anytime you are talking about how you're storing your cryptocurrencies, you should be as general and non-specific as possible, because you don't want to tell anyone how you're storing your coins. You don't want to make it easy at all for them. Basically, what I'm going to say here is storing your coins on a hardware wallet is a very good idea. Far more better than using a centralized exchange. Learning how to use a hardware wallet is a great use of your time. Also, if you don't feel comfortable with having, let's say, all of your cryptocurrency investment on one hardware wallet device, that makes you uncomfortable, buy two and divide it up. But just keep in mind that the more you divide it up, you have to store and secure the seed phrase and those devices, the seed phrases for each device and the devices themselves, in a separate but equally secure manner, because just keep that in mind. You have to find the balance between what makes you comfortable and what you're actually capable of securing and maintaining that security, because it is on you. That's the beauty of cryptocurrency, is that it's your responsibility.
So my suggestion is just get creative. Very, very, very creative.
And we'll leave it at that.
Yeah.
Okay, last question here. Hello, I saw your recent video about those who tried to short Bitcoin, and I gathered that those who shorted should not be doing so. After researching what shorting is, I have the following question. Can you please explain the difference between shorting a coin, which he's saying is selling high to buy back low, and what you guys typically do with other coins, selling high and buying back low? I thought this was the whole idea of investing. The difference between what you just said of shorting and timing the market is that shorting involves selling coins that you don't own. You're selling coins that you have borrowed and that you need to pay back. So shorting is when people put up shorting orders, it's public domain, right? We can see when those orders are placed. We can see how many shorts are being put up, right? And that means that a lot of people are anticipating the price to drop, because, like we explained in our past AMAs, hopefully you caught that one. But basically, let's say I borrow Bitcoin from Toby. I borrow one Bitcoin, and I sell that Bitcoin on the open market. Let's say Bitcoin's at $10,000. So I owe one Bitcoin to Toby. I have $10,000 in cash. I want Bitcoin to drop to 5,000, or at least lower than 10,000, so that I could buy back at a lower price. I spend 5,000 and I still pay back Toby one Bitcoin, because Bitcoin is now at $5,000. I keep $5,000 in profit. That's what shorting the market is. The difference here from doing that and just, let's say, Bitcoin's at a full-fledged bull pump or whatever, and it goes to like $100,000. Yeah, you can take some profits there and wait for it to drop again and to buy back. But the difference is that you're selling coins that you owned. You're not borrowing from someone else to do so. So there's no added pressure of, if the trade goes the wrong way, other than you're just losing your own money.
That's why we hold.
Yeah.
Yeah. I don't have time for that.
Also, just it's kind of like we explained in the video that you mentioned. What we thought about shorting is, it's a really small mindset for Bitcoin. It's a really greedy mindset, because the amount that it will go down is just pales in comparison to the profits that you could see with the upward cycle. So
yeah. That's it.
Yeah, that's going to wrap it up for today's episode. Thank you guys for tuning in. If you like these videos, we appreciate it if you hit the like button. And if you'd like to subscribe to get more videos like this on the daily, I suggest you hit subscribe. What else should they do, Toby?
Stay disobedient and don't follow shit. Definitely don't follow them. Bye.
Okay, we'll see you. Bye.